Welcome to Trends with Benefits, an award-winning podcast by Van Eck with a forward-looking perspective. We explore new ways of thinking about the markets, work, and life. Here's your host, Ed Lopez.
Hi, Mariann. How are you?
I'm great.
Well, I've been looking forward to this because, one of the things that I think I want to talk to you about is retirement and preparing for retirement. And, I imagine one of the most popular questions I'm guessing is, when can I retire?
I'm getting questions from people of every age group, of every generation. What do I do in retirement? Because basically, you're planning for a time when you no longer receive a paycheck.
And it's different these days, I think. Well, as I think about the growth of defined contribution plans since the 80s, and people have moved away from defined benefit plans, right? And so now more of us are in charge of our own futures and investing for our money to last us 30 years or more, right?
Yeah. So in the situation of, 401ks and these instruments where people have to manage the money themselves, it's really, an interesting time for people. There's more information available on the internet, and AI is already embedded in most computers. So there's just a plethora of data and information. In the past, people relied on professionals to manage their money, and it's another language for a lot of people. A lot of people have expertise in their own fields, whether it be healthcare or government or production or whatever. They're looking for help, and they do need help.
Yeah. So it sounds like there's hope. So that's good. Technology and people out there, people like you as well, to help people. Officially, welcome to the Trends with Benefits podcast. I'm speaking with Mariann Montagne. She is president of Mosaic Consulting. She has a wealth of experience in portfolio management and selecting ETFs, mutual funds, individual securities, and analyzing markets. And so it's a real treat for me to be able to talk to her and tap her experience with everything investing. But in particular, we're going to focus on retirement. So Mariann, thank you very much for joining the show.
Oh, thanks for asking me to be here, Ed.
I'm kind of curious. You've held a number of positions. You were a portfolio management consultant prior to starting Mosaic. Do you consider yourself retired, or you just decided to do something different? And I guess kind of given our topic of discussion, just kind of curious of how you look at it.
I think I've achieved a point in my life where I really don't want a boss or need a boss. I think that's a point where a lot of people want to be at some point. And, for some people, they go off and they do duck hunting and, do some really serious traveling. I couldn't see myself doing either of those. I just have always had my ear to the rail in the financial markets. And I was at a point in my life where I decided that I wanted to help others to understand this other language, investments. And, it was sort of a time when I wanted to do something to leave to my children and my grandchildren. Of course, a lot of things change, but investor behavior really doesn't change through the decades. So to just give people insight and help them to, find their way through, I've done a lot of work on women and wealth. And that's certainly an important sector for me. I was a divorced woman with 3 young kids, and I had been out of the markets for a few years and had to come back and kind of pedal hard to make up time, and was able to do that. So I just want to share my learnings with other people. And, the bottom line is I want to help other people sleep well at night.
Yeah, that's great. And I forgot to mention, you have a podcast. You're the host of Thriving with Your Money Tree. How's that going?
That's going really well. Again, when you leave an organization and put everything pretty much on your shoulders, you have to develop some new skills. So I will say that I have unofficially a certificate in editing, and that was probably my biggest bogey through this whole thing. Otherwise, it's all been, like learning something new every day, which I've done my whole career and I've loved doing.
Yeah, it's neat when you have like a different project and focus on something totally different and a new learning. So that's cool. I'm excited for you. I'm kind of curious, given your decades of experience in financial markets, and maybe to put this whole discussion in context. I mean, you mentioned, investor behavior really doesn't change from when you started to today. What do you think is different in terms of the investment markets or the way people invest today?
Well, what's different? Let me start by saying back in the day, a lot of people ascribed to these investment newsletters, none of which have survived, none of which prove the test of time. Another thing is stockbrokers used to dominate investors' mindsets, and they always had a hot stock for you, and they always wanted you to make a trade. Well, that's been replaced with financial advisors, and in particular, fiduciaries. So fiduciaries have to put the customer first. And I've been a chartered financial analyst my whole career. And part of that being a CFA is that you have to sign a code of ethics that says you always put the customer's interest first. So the rest of the financial world has had to catch up with that. Another thing back in the day is that people used to run into the markets real quickly and run out of the markets real quickly. They still do that, but maybe a little slower because you can Google any hot topic and find the pros and the cons of these stories that are driving people. But there's always a fear of missing out. People are always trying to time the markets. And in fact, what they found is that if you miss the top 10 days in a market cycle, you miss the vast majority of the upswing in the market. And certainly if you miss the top 20 days, you miss almost the whole upswing in the market. That's just something that it doesn't stop. It's human behavior. They're always second guessing themselves. And, part of my process is to teach people to lose the emotions, look at the numbers and realize that, an 8 or a 9% pullback in the market is very, very normal in the course of the year from a peak to the trough. And still the market could be up, nicely. So from the beginning to the end of the year. So just be patient about that. I try to compare it to going shopping. I go to see a dress in a store and I really like it one week, but I don't buy it. And then I come back the next week and it's at a 20% discount. Is the dress any worse than it was the prior week? No. Is the story, like I need it for a specific event or something, is that story intact? Do I still need this dress? Yes. Why the heck wouldn't I buy it at a 20% discount? So that's the way it is with stocks as well and bonds.
Yeah. At least sometimes the stores tell you when a sale is coming, but you don't know when a bear market's coming.
That's true. Although I ask a lot of stores and they're like, oh, I don't know. So it's just like the stock market.
Yeah. And to your point earlier, like investor behavior, it's the same, right? I mean, new technologies, new ways of getting information, but this sense of FOMO sometimes, or the sense of, I don't want to buy right now because the market's down. And, it's investors, I think, should almost do the opposite of what they think or feel.
Yeah. The George Costanza day, when he should do everything opposite to what's, normal for him.
Yeah. And so now you've got this intersection of investors, a whole cohort of investors that are in control of their retirement destiny and these 401k plans and the like. Just at a general level, do you think that people are better off with 401k plans, or should we have kept like more pension funds available for people, and should we go back to that?
Well, first of all, it wasn't up to us for the pension funds to go away. We don't have a decision in that, and sometimes you just have to let go of that idea. In terms of using 401ks today, I think, number one, a company that provides matching, and most do, is offering you free money. Secondarily, companies that offer matching in the 5 to 10% range are, going to be more attractive employers to that person than companies who don't. So if you're looking for people to hire, you should raise your matching amount. Thirdly, there is a whole host of information out there. And, you can talk to a financial advisor, when you only have money in your 401k plan, you can pay them a fee and ask them what I should do. Most companies have between 20 and 30 choices. It's pretty overwhelming. And I have addressed that on one of my podcasts, how to choose from all those things. They don't have to be static. You can make changes. I don't think people realize this, but you can make changes any day of the week. I don't advocate that, but I would say maybe look at it every 6 months and decide, is that an area that you want to stay in, or maybe you should move on depending on market conditions. So you can tweak that 401k throughout the years. But basically, if you have 20 years to go in your 401k program, that's money that's growing tax-free in a traditional 401k. And you're purchasing every payday, so you're dollar cost averaging. You're buying when the stocks are kind of low sometimes, kind of high some other times. But the markets go up about 75% of the years. So the stock market, that is. So why not participate?
Are you a proponent of maxing out your 401k contributions?
Well, it really depends on your individual situations. Again, I was a single mom with 3 kids headed to college. I was not about to max out 401k contributions. I wasn't in that position. It really depends on that point in your life. Maybe when there's no kids involved, or the kids have their college money all allocated. Maybe then you want to put your monies to work. You may still have another 10 years or 15 years of growing that money, before you go to retirement. But wait, we don't stop at retirement. That flows into your hands or your financial advisor's hands, and you can continue to grow that money over long periods of time. And, it really depends on the individual and their risk tolerance, but I can go into that later too.
Nowadays, there's the idea of a Roth 401k. I don't know if you have thoughts between just a regular or a Roth. It seems like the Roth has a lot of potential benefits for investors.
Yeah. So my answer is yes, both. Okay. And the reason being is that for the most part, the value of the Roth is determined by the tax rate in the future. And nobody can tell us what that tax rate is going to be. The pessimist says the government will always raise tax rates. The optimist will say, well, there's enough money there and you can pay the tax rate, which could be the same as now based on whatever monies you pull out of that fund. And at a certain age, depending on the IRS, depending upon when you were born, you will have some minimum distribution requirements for a traditional 401k. So you will have to take money out and you will have to pay taxes on that. There's a charitable, I won't say loophole, but particular situations where you can avoid some of the taxes. And I'm not a tax expert, but with the Roth 401k, you're paying taxes up front. So you're going to miss all the money that you put into the Roth, where you don't miss all the money that you put into a traditional 401k. Now, on the time after you get the paychecks, you could take money out from that Roth, or you could leave it. You could leave it forever. You could let it grow and grow and grow and grow. And maybe that's the money you pass along to grandchildren or some significant charity recipient will get the bulk of that or all of that. And it's just grown and grown and grown and never been taxed. So, it depends. But personally, I have money in each, the traditional and the Roth.
So, before we get to talking about what to do in retirement, we talked a little bit about what to do preparing for retirement. I'm curious if you've seen any glaring mistakes that people make preparing for retirement, or any best tips that you might have, something to think about as they put together a portfolio for themselves.
Wow. Well, there's a lot
Another broad question. So.
Yeah, that's a broad question. And again, people start thinking about retirement in their 20s and 30s. And here's where I'm going to call it a short list. It might seem like a long list to other people of things to avoid as you're building toward retirement. So the first mistake people make, and they can start as early as their 20s or 30s as they're looking for retirement, but one of the big ones that they make the mistake with is not diversifying. So, instead of having their money spread out over a number of investment ideas, they put all their chips on, for red or something like that. It's just dangerous. It's a quick way to lose money. And then the second thing that they make mistakes with is getting too emotional. Again, you have to know that the market's going to fluctuate from the peak one year to the bottom, and within that year, have an 8 or 9% pullback is very normal. And don't cash out just because the market is down. Thirdly, just trying to time the market and say overall it's bad or it's good, and it's better to dollar cost average throughout your time. The next is people who buy stocks under $5. They think it's going to double or triple. You laugh, but it's amazing how many people try this. And then when they've lost their $100,000, they're like, oh, well, and they're not feeling like that on the inside. So a stock under $5 is far more likely to go to 0 than it is to go to 10. And the last thing I'll point out is ignoring liquidity issues. You have to realize that when you tie up your money, something may happen. I mean, stuff happens all the time. And you may go to reach for that, and then you get reminded, no, you locked this money up for 2 years or 5 years or what have you. And maybe you have to get in line between other people who want to redeem out of an investment, and the money just isn't available when you really need it.
For different types of people and at different age groups, very young to those that are close to retirement, I guess the common sense or maybe the common rule of thumb is if you're young, you can be aggressive and go all stocks or some combination of S&P or small cap stocks. And then as you get older and you approach retirement, you go a little more conservative, you dial it back and maybe add some bonds. I wonder what your thoughts are on that in general, and perhaps on the idea of target date funds, those funds that kind of do it for you and dial back as you approach retirement.
First of all, I would say that there are a lot of young people out there who are very conservative. And if they were to receive some hot tip and they followed through on it, they might not sleep well at night, no matter their age. So I would say no to being more aggressive early on. It could work for a lot of people, but it doesn't work for everybody. Secondly, I think people get a little more desperate as they're in their 40s and 50s, look at their accounts and say, well, this isn't enough, and then they start getting super aggressive. And that can be a very, very dangerous period for a lot of people. But thirdly, as you age, and I'll tell you, my dad is 103. And so when he retired at 65 years old, he asked me how he should invest his money. And I said, growth stocks. You can be aggressive. You've got probably another 30, 35 years ahead of you of investing. And that's the way it's worked out. Now, I will say when he hit 90, we decided, maybe growth stocks isn't the best idea here. And so we went more conservative, but still companies that could provide growth opportunities and add some income. He was still traveling hard in his early 90s, and so he's liked spending the money. But yeah, he's become a little more conservative in the last 10 years.
As we go into retirement then, so let's say somebody's saved up, they've got their 401k. Do they, I don't know, I'm guessing, do they make changes to it after they enter retirement or just?
Oh, absolutely. So here's a classic example of making changes. And I'll start by saying, most people do start talking to a financial advisor as they're on the cusp of retiring, and they want to know, what can I do now with this 401k money? And I think what people need to do is to sit down and say, what are your plans for retirement? What are your income needs? And say you needed $100,000 in income. And say that you have $2 million put away. And so that's about a 5% yield. So how do you get $100,000 out of that without destroying the value of your portfolio? The first thing we do is we sit down and we say, well, how much will you receive from Social Security? They send you a annual letter so you have a fair idea of what it's going to be. And the next question is, do you have any properties or businesses that will generate income for you over the course of the year? And so let's set that aside for a minute. But with Social Security alone, let's say you get $20,000 a year, $25,000, somewhere in there. The next thing to look at is the annuity. So today you can get a 5% return from an annuity. To get the dollars that you would need, you would probably have to put 500,000 of that 2 million into an annuity. Next, we would recommend you look at higher yielding ETFs that are out there. So remember, exchange traded funds are pools of stocks or bonds that give you good diversification across a narrow sector of the market. And a good example would be preferred stocks. So an ETF with preferreds will give you, maybe 200 different companies with preferreds, and on average, say a 6% type of yield. Well, we take other asset classes within that high yield sector, and we create a portfolio of, say, 10 ETFs from 10 different asset classes. So some of these other things besides preferreds would be just high-yielding stocks, some high-yield bonds. Some people refer to them as junk bonds. I like to go with something that is actively managed so that they are not junky junk bonds, but maybe premium junk bonds, if there's such a thing.
Higher quality junk.
Right. And then there's other classes like senior loans, collateralized loan obligations, master limited partnerships or energy infrastructure. There's emerging market debt. There's U.S. Investment grade debt. You put all of these, say, 10 different categories of 10 different ETFs together, and some may go up a little, some may go down a little, but they kind of balance each other out over time. And what you can do in today's market is receive about a 7 or 7.2% yield off this money. So in order to generate the income you need to combine with the Social Security annuity money and this particular high yield type of strategy, you could still, out of that $2 million, have another $850,000 left over. And depending upon how conservative you are, how growth oriented you are, you could put that into growth stocks, or you could put that into some other more neutral kind of bonds. You can just answer your needs in your total investment program with different types of strategies.
Yeah. I mean, definitely add up what you think you might spend in retirement or what you might need on an annual basis, and then kind of put the pieces together to see kind of where that income falls out. I do got a few follow-up questions to some of the things that you mentioned, but one being, if for simplicity's sake, let's say that I think the 30-year Treasury's 4.74 kind of as we speak, or something around there. But let's say, for simplicity's sake, let's say it's 5%. So in your example, if I had a $2 million portfolio, why couldn't I just buy a 30-year Treasury and call it a day and get my $100,000 a year?
Well, you could if you're going to hold that Treasury for the rest of your life. But the problem is that Treasury values go up and down. And the longer the maturity, so 30 years versus, say, a 2-year, the longer your maturity, the more volatile that is. So people who think that the price of U.S. government bonds doesn't fluctuate, that's not true. That's not the case. And again, we want to have money that you can reach for just in case something happens. The Treasury money may not be there.
And so you need to reach for a little bit more yield and some of the different asset classes that you mentioned, like high yield bonds or preferreds, to get that extra growth, that extra income, so you can build that extra cushion. Is that what you're saying?
Well, I wouldn't look at that particular portfolio as a growth portfolio. I have compared it to a fruit tree that gives off a lot of fruit, in the terms of dividends and interest income throughout the year. So it's really like the ideal money tree that you can pull from, but it doesn't grow. It really, for various reasons, they typically do not grow over time. That they may grow a little bit just to cover your expenses. And again, the beauty of using ETFs is that you have very low fees. So you can expect to pay maybe 0.50% or 50 basis points on average for a portfolio like that. Maybe a little bit more if you lean on teams who will sort through all of those holdings and, be more active traders within the ETF, but well worth the money.
Yeah. Now, let's hope people are going to use an advisor to kind of walk them through this. But for those do-it-yourselfers, you could look and find, 13% mortgage REITs or, business development companies, and they might have equity-like volatility. How do you think about that? Or how do you manage that? Is it the fact that you just diversified across, say, 10 different assets or differentiated assets that should really help tamp down the volatility? Or do you suggest people go do some statistics and look at yield for level of, this is technical, standard deviation, or something like that?
Yes. So I think the latter. And just from a layman's standpoint, you could look at REITs that are maybe commercial type, which are kind of iffy. And I wouldn't reach for the 13% type of REITs, as in every category, stocks, bonds, alternative asset classes. Typically, when the yield is super high, there's real doubts about whether that payment can be continued. I would say I would look for REITs that have less volatility. Think about self-storage units. Those are things that people keep full all the time, no matter what the economy is like. They make those little payments every month to keep their stuff in storage. So that's less volatile than something like commercial real estate properties.
Yeah. Now, I know you look at this part of the portfolio or these income-producing assets as not really providing growth, but at times there are pockets of opportunity, right? And maybe there's an opportunity in commercial real estate, or maybe there's an opportunity in munis because it sold off in the last year. Would you advocate kind of looking for those value opportunities and fixed income?
Yeah, actually, I think there's an opportunity right now in emerging market debt. So a lot of people associate that with China, but all the ETFs for emerging market debts do not contain China. So take a look at the holdings, make sure you're comfortable with those countries. There's no geopolitical risk going on. And the spread or the difference between the yields on emerging market debt and U.S. government yields is currently about 3 whole percentage points. So I think that's an area that's interesting. And also, I've seen data that shows that institutional investors think that emerging market debt as a group is out of favor. Well, when they all think one way, I usually, go the other way. It's contrarian investing, but it pays off over time. So when there's a particularly low level of interest in a category, that generally piques my interest.
As we start to close out, one question I like to ask guests is about long-term trends that they see or that they're watching. What's one long-term trend you see playing out over the next year or several years?
Okay, so this actually started about 30 years ago, and it's all about the demographics of China. With their one-child policy and other policies, you ended up with a population who are now in their 30s or so, and it's heavily weighted toward men. There's very few women for these men. And so what does a society do? Well, they put them to work in the military. They create, imagined threats that somebody's going to come and attack them. And so they must defend themselves, and they must put their people and their monies into military defense, shall we call it. And of course, the other countries have to respond. So other countries being Taiwan and South Korea and Japan and the U.S. And so I think that we're in the early days of a buildup in military spending globally that is going to persist for another 20 years or so. So that's an area of investment that I think there's still opportunities in, both for military spending and also for security, cybersecurity.
So let's round out the show with a round of trend or fad. I'll ask you about a few concepts and get your quick take.
Okay, I'm ready.
The return of the 60/40 portfolio, trend or fad?
Fad.
Reshoring, trend or fad?
Trend. In fact, I've heard one person refer to the upper Midwest as the new emerging market.
India, trend or fad?
Trend, but long-term trend.
Blockchain or crypto, trend or fad?
Blockchain is a trend. Cryptocurrencies, for which there are far too many, are very much fads.
And I think the right way to pronounce this is padel or paddle. It's a sport. Do you know it?
Ask me about pickleball.
Okay, pickleball, trend or fad?
Trend.
Yeah, it's been more of a persistent trend than I thought. Oh, this is awesome. Mariann, thank you so much for your time. What's the best way for people to learn more about you and about what you're doing?
Well, again, I am at Mosaic Consulting, LLC, and the name of my podcast is Thriving with Your Money Tree. So, as much as you may live in New York and never plant a seed in your whole life, I think people understand the concept of gardening, and everyone wants a money tree. So tune in to thrivingwithyourmoneytree.com, and we'll tackle all kinds of topics.
Fantastic. This is awesome. Thank you so much.
Thank you.
And thank you for tuning in to another episode of Trends with Benefits.